Hello and welcome. You're watching Market Masters on Business Today Television, and I'm joined by Arvind Sanger, Managing Partner at Geosphere Capital. Welcome to the show. We are decoding the aftermath of this bombshell announcement for global trade, and I want to jump straight into the question in terms of the impact. First up, explain to our viewers here in India the manner in which this is going to play out in global markets in the near future, Arvind, the impact of these announcements.
Well, first of all, the markets are trying to determine how much negotiating room there is in these tariffs. But it sounds like it's going to be very hard to completely roll these back, or that everybody can negotiate at the same time. So these tariffs kick in very quickly. There are some auto and other tariffs that kick in, I think, have already kicked in, and then there are other tariffs that kick in on Saturday night US time. So I think the time to undo any damage is going to be very limited. So I believe that this is going to create huge global turmoil in terms of supply chains, in terms of business decision making, and the idea that this is going to magically reshore manufacturing in the US is ludicrous. I mean, the kind of stuff that we import from Cambodia or other poor countries, Bangladesh, suddenly we're going to be having people making low-end textiles in the US. These are all ludicrous ideas. Unfortunately, we have a president who has believed in some of this fairy tale concept that trade deficit, goods trade deficit, is reflective of people taking disadvantage of country, not taking into account services trade, and so I think that the damage is going to be potentially both a recession and inflation, which is unfortunately was popularly coined in the 1970s as stagflation.
Arvind, in terms of the sectoral impact, you did briefly mention automobiles as an example, but if you were to look at it in a more detailed way, which sectors do you believe will be the most impacted, and how should investors therefore respond in terms of their portfolio choice?
So yes, auto component manufacturers around the world and auto manufacturers in the US, all of whom depend on a global supply chain, will be impacted. But it's not just that. From a US standpoint, anything that uses steel, anything that uses aluminum, those are items that have already been subject to tariffs. If you're looking at from an Indian investor standpoint, the IT services companies didn't get tariffed, but their business depends on US clients, and if the US clients are going into a recession, that's going to impact their willingness to give out more IT service contracts. So I think IT services are hurt there. Pharma hasn't yet been tariffed, but I would not be too quick to assume. President Trump has been very clear that that's coming. So there are other things that are coming that are going to be negative. So the pharma sector is currently seeming like it's safe, but I'm not sure it's safe. So I would say, from an Indian investor standpoint, domestic economy facing companies are going to do way better. Domestic service industries, but keeping in mind that the Indian economy will feel some negative blowback, although nowhere near the negative blowback that other more export-dependent economies will feel. From a US standpoint, I think we're going to get the worst of all worlds, which is both an inflation and a recession. The rest of the world will just have to worry about recession, not inflation.
Arvind, in the recent past, in the market correction that we saw in India, IT, including stocks like TCS, let's bring that up, have seen significant correction, and you're absolutely right. Nearly 50% of large cap IT sector business comes from the American revenue market, and obviously they are going to be impacted in the second round. Do you see any possibility of IT companies being able to diversify their markets? They've also already been buffeted by technological changes, or should we remain doubtful of their capability in this regard?
Well, I mean, it takes a long time to diversify into other markets. US is the most open market in terms of IT outsourcing, and like you said, the technology, the quickest, fastest change adoption in AI applications is in AI for writing software code. Today, you're seeing companies, startups do it with one engineer without needing a lot of people. So the era of junior programmers, who do a lot of grunt work in these IT service companies is over. And to me, that is actually one of the biggest challenges for India in terms of employment creation. This has been a little hidden engine that has worked well, and it has created more of a ripple effect on benefiting the domestic economy in other ways. So I'm not an IT fan, and this just puts another. But having said all that, companies will need help, whether it's in the U.S. or elsewhere, in implementing AI. So niche companies that are able to help in that will be able to overcome the short-term slowdown will be there, but they will be able to overcome it. But I think from an Indian investor standpoint, there are so many more domestic-facing companies. There's such a wide variety of choices. Why try to pick the bottom in the IT sector?
What specific choices come to your mind that you can share with us across sectors in terms of diversifying portfolios and mitigating risks to some extent, Arvind?
Well, so there's been talk recently about India putting tariffs on Chinese steel imports. If that happens, the Indian steel industry benefits. If you look at Indian, infrastructure, Indian industrial spending, Indian, capex, Indian consumption, to the extent that the capex is starting to recover, consumption has been pretty weak. But I think as RBI starts to loosen, that could benefit. I think these are sectors. There are plenty of sectors which benefit. The one sector that I worry about is the beneficiaries of PLI schemes. Because yes, India has gotten hit with less tariffs than China, but it is not necessarily the choice, and it's gotten hit with less tariffs than Vietnam. So maybe the apples of the world keep moving from China, and maybe don't go to Vietnam, come to India. That may be the bull case. But the bear case for the PLI scheme beneficiaries would be if companies look to reshore in the US because the tariffs from anywhere are too high. So I don't know. The jury's out. I'm a little more uncertain about that. But the domestic-facing consumption stories, I feel like should be the relatively better places to benefit from what is likely to be a tough global economic growth period, but India, because of its a domestic-facing economy, should do better.
Since interest rates came up, I want to ask you, what is the likely response of central banks in the large economies as a response to this ongoing trade war?
So in the rest of the world, if there's an economic slowdown, whether it's in the EU or it's in Japan or elsewhere, I think rate cuts are back on the table and are likely to continue to be trying to offset what is coming from the tariffs. In the US, the Fed has a much harder path to went through because on the one hand, they have to fight inflation. On the other hand, they have to fight or offset slow economic growth. And inflation, I think, is more of a concern than slow economic growth. And I think if we get stagflation, and that's a US unique problem, unless we get global trade war. So the one risk for all central banks is if this turns into a global trade war, tit for tat tariffs, everybody kind of imports stagflation from the US. If that happens, then central banks will have a much harder time. But assuming that there's an economic slowdown globally and stagflation doesn't take hold in the rest of the world, then I think the rest of the world central banks will have some room to help by cutting tariffs. Whereas in the US, I think the central bank Fed will have a much harder time.
Arvind, let me also ask you one more question before we thank you. And this is for the benefit of our domestic audience. And I've been having these conversations, and one point stayed with me. Somebody I was speaking with said, can you explain how President Trump, who is elected through popular votes, is factoring in the possibility of higher inflation in the US and seems to be discounting it in terms of the political impact? Why is that? Is it because he's just 2 months into his 4-year term, or is it because like the previous president, he can then come up with a pot of money to help reduce inflation? how is he able to appear so sanguine with regard to the inflationary consequences of his actions?
He seems to believe, and uniquely kind of in his mind, and he's believed it, I guess, for a long time, is that this will be a short-term pain, and then by the time the midterms roll around in end of next year and the presidential elections in 2028, the worst of the effect will have passed. There'll be a one-time hit. The inflation will reach, price will reach a new level, and then they'll even out. In the meantime, his view, I don't think most economists subscribe to this view, is there's going to be such a boom of manufacturing jobs, such a boom of domestic wages, that people will not feel bad about this one-time price adjustment because they have more money to spend. I think it's a complete fantasy. I think it's nonsense economics. And I think the country will pay the price for one person's strange economic theories. We've seen what has happened in Turkey when you have president who has uniquely unconventional and uneconomic economic beliefs, how that has had an impact on Turkish lira and Turkish economy. I didn't think of US as a third world country, but we're about to find our own kind of strongman doing strange things and seeing how the economy reacts.
One final point very quickly. Is there any winner out of all of this that you see in the medium to long term?
I'm sure there will be winners. There'll be winners who are, a domestic steel company in the US will be a winner. A domestic steel company, to the extent that India imports tariffs on Chinese steels, they'll be winners. So there'll be pockets of winners of companies that are competing against imported. So if somebody makes cars in North America that is USMCA compliant and is able to assemble its car without any duties versus everybody else who's bringing auto parts from elsewhere, those will be winners. So there will be people who will be shielded from these tariffs who will be able to raise prices. Those are the winners. Certainly from a US standpoint, there will be some winners, but they'll be few and far between, and everybody loses from a recession. Except maybe those people who make payday loans and those who benefit from a recession. Other than those, there will be a lot of losers.
Absolutely, and that's spot on. And very clearly, in India, one of the debates is the auto sector. We have a robust auto sector, and Tesla's launch